Hi, I'm Cathy McBreen, president of Millionaire Corner, and we are delighted to have here today Luke Knecht, one of the foremost leading fixed income portfolio managers in the country. Luke, who you will meet in a moment, currently works as a partner at Dearborn Partners in Chicago, Illinois, which is a SEC registered investment manager. Prior to that, he worked at Dresner RCM Global Investments, and prior to that, he was the chief investment officer at Harris Investment Management. Hello, Luke. We're glad that you're here.
Thank you. I'm pleased to be here, Cathy.
So how does an average investor figure out maturity, and if they decide to, how would they decide if they should be selling a bond, or how do they get out of a bond if their maturity is currently a long maturity?
Well, the most effective way to categorize the risk of a bond is with a measure referred to as duration. And duration's a little different than maturity, although they're related.
So is maturity the date that it comes due, basically?
Yes.
And duration, what is that?
Duration is, to be technical, a time-weighted present value of all of the cash flows in the bond, as opposed to the last cash flow, which is the maturity date.
Okay.
So duration takes account of all of the cash flows in a bond, and it's particularly useful because if you know the duration of a bond, you can pretty directly estimate its price change in response to a change in yield. So for instance, if I have a bond with a 2-year duration and interest rates change by 1%, the price of that bond will go up or down by about 2%. If a bond has a 10-year duration, the same 1% change in yield will cause its price to go up or down by about 10%. So a 10-year treasury today has a duration, let's say, of 9, slightly shorter than its maturity. If rates were to go from 2 to 3 or 2 to 1, the value of that bond would go up or down by about 9%, which is a lot in a short period. As to your question, how do people get out of bonds? Well, there is a very liquid market for bonds. It's not like the stock market. It's mostly an over-the-counter market. Bonds are traded between dealers, as opposed to on an exchange, as many stocks are. But most bonds, particularly in the investment grade arena, there's a very active market for them. And of course, the relationship is as yields go up, prices go down, and as prices go up, yields go down.
Okay.
So investors who were smart enough or lucky enough to buy bonds when rates were much higher have experienced big gains as rates fell, the prices of their bonds went up.
Thanks again, Luke, and thanks for watching Millionaire Corner.